Investing legend Peter Lynch's top 9 investment lessons. So before we get to Peter Lynch's top 9 investment lessons, let's just cut to a clip from one of Peter Lynch's most recent interviews he's done, and then stay tuned to the end of the video where I'm going to give you all a sneak peek into Finance Uncut Insiders.
In the stock market, the most important organ is the stomach. It's not the brain. There's always, on the way to work, the amount of bad news you can hear is almost infinite now. So the question is, can you take that? I mean, do you really have faith that 10 years, 20 years, 30 years from now, common stocks are a place to be? If you believe in that, you should have some money in equity funds. I mean, it's a question, what's your tolerance for pain? I mean, the stock market's a very good place to be, but I can toss a coin now. Is it going to be lower 2 years from now? Higher? I don't know. More people lost money waiting for corrections and anticipating corrections than the actual corrections. Well, you ought to look in the mirror every day and say, what am I going to do if the market goes down 10%? What am I going to do if it goes down 20? Am I going to sell? Am I going to get out? If that's your answer, you should be reducing it today. Well, I had this perfect record. I think the 13 years I ran Magellan, the market went down 9 times, 10% or more. I had a perfect record. I went down more than the market. Every time I went down more. So I just didn't worry about it. The point is, would you say to yourself, do I need this money in a year? Do I need this money in 2 years? Do I need this money in 3 years? So my longer term, stock market's been the best place to be last 10 years, last 30 years, last 130 years. But if you need the money in 1 or 2 years, you shouldn't be buying stocks. You should be in a money market fund. Well, I think emerging markets, and that's not my expertise, but I mean, these markets have been really hammered. You know, and a lot of countries are doing a lot better. You know, I mean, so I think there's potential there. That's not my expertise, but I think emerging markets could be a place to research. I never looked at the economy. I want to find out. The only thing I would look at what's happening right now. You know, what's going to happen a year from now? What's going to happen to interest rates? I'd love to get next year's Wall Street Journal. I'd pay an extra $1 for it. That'd be very helpful. I don't know what's going to happen in the future, but I want to find right now. Well, I think anybody that's investing in the stock market has to understand, you buy a company. These are not lottery tickets. These behind every stock, there's a company. If the company does well, over time, the stocks do well, and vice versa. You have to look at the company. That's what you're researching. That's what we do at Felly. That's what I do. You could be an interventional cardiologist, and you're putting in Abiomeds in Pella. You say, wow, this really is an incredible breakthrough, preventing shock, preventing hemodynamic support. It's amazing. It's a breakthrough. It's great. It works. But you're actually using it. I mean, or you're assisting. You're in the operating room seeing this breakthrough. That's, you saw way ahead of most people. That's an edge. You need an edge on something. Well, the data now is so good. I remember when we owned Nike, we had to wait for the mail to come to our library. Now, when somebody reports earnings, it's telecast all over the world. They have an investor presentation, they show a balance sheet. So information is much better. So theoretically, the individual's edge has improved in the last 20, 30 years versus the professional. The data is there. It's free. But I think a lot of people, their problem is they have so many prejudices, they have so many biases. They won't look at a railroad. They won't look at an oil company. They won't look at a steel company. They're only going to look at companies growing 40% a year. They won't look at turnaround. So one thing, you just don't have so many prejudices and biases. I bought companies with unions. You have to really be agnostic.
So let's have a look at this Yahoo article with Peter Lynch's top 9 investment lessons. Number 1, in the stock market, the most important organ is the stomach. It's not the brain. Lynch explained that investors need to know their pain tolerance and often succeed if they simply hang on to their holdings. And this is an important one, and this is why I will never be a financial advisor. Because, once again, when I buy a undervalued stock and it goes down 30% or 40% or 50%, I get excited. I feel great about that. However, most people cannot handle a market or a stock going down that much. Or if I buy a stock, I don't expect it to do much for a 3, 4, 5 year period over that business cycle. However, others, if it doesn't go up in a month, 2 months, 3 months, then they're like, what's going on? What's going on? So true, this one. And as I said, that's why I'll never be a financial advisor. It's not worth the headache. All right, number 2, you've got to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do I do if it goes down 20%? Am I going to sell? Am I going to get out? If that's your answer, you should consider reducing your stock holdings today. Good point. Also for me, when I see markets overvalued, when I don't see the growth there, then I will take profits and I'll move to the side. Sometimes, and usually I'll wait for the market to actually start to crash before I actually start shorting the market. I'd rather be a little bit late when it comes to shorting than early. But if I think the market's going down, into a bear market more than 20%, I'll move out of the way. However, if I'm buying an undervalued stock that's already undervalued and it goes down 20%, that's cool with me. Buy more. So, it really depends. So right now, I think, the overall general market, the index, is overvalued, and I think it's got a long way to fall yet before it becomes any type of value. Number 3, stocks aren't lottery tickets. Behind every stock is a company. The company does well. Over time, the stocks will do well, and vice versa. You have to look at the company. That's what you research. Pretty basic stuff for us stock investors. That's what it's really all about. So once again, I have a lot of friends who ask me about stocks and shares, and they're like, oh, isn't it just gambling? Or they've got no idea. You're buying a piece of a business, and you want that business to grow its earnings. You want that business to share either back to shareholders in the price of stock appreciation or in the form of dividends. Anyway, number 4, the public's careful when they buy a house, when they buy a refrigerator, when they buy a car. They work hours to save $100 on a round-trip air ticket, yet they'll put $5,000 or $10,000 on some zany idea they heard on the bus. That's gambling. It's not investing. That's not research. That's just total speculation. Once again, similar kind of thing what we're talking about. People just want a stock tip. They don't want to learn how to invest. They don't want to learn how to read financial statements and balance sheets. They don't want to do that work. So that's pretty straightforward. And anyway, number 5, in baseball terms, you want to buy in the 2nd or 3rd innings and get out in the 7th or 8th. Lynch gave the example of Walmart, which only had stores in 15% of the US. As a 10-year-old public company, spent the next 30 years expanding nationwide, and its stock skyrocketed 50-fold during that period. And this is why I love buying small companies. I really specialize and focus in small cap stocks. And for those that end up being part of the Finance Uncut Insiders, you'll actually get more information about what type of small cap and the market cap size. And I'll show you guys, especially in the mining and exploration sector, that different small caps with different market capitalizations do much, much better than others. In fact, I break it down into 4 different parts, and you'll see which ones do better in that. But I like buying small companies that become big companies. So number 6, when the business goes from semi-crummy to better to good, I'm probably out. You sell the company. That was a growth story when there's no room to grow. The only time I buy large companies that are slow growers when I can sell covered calls for extra income. So if I can get 2% a month on a big, boring stock that grows extremely slowly, that might pay out a 5-6% dividend as well, then I'll sell covered calls on that and pick up 2% a month, 24% a year with that extra dividend. We're looking at 30% return. So those bigger companies, can be very, very good to generate income. But if you really want to turn, $100,000 into $500,000 or $1 million, get that big capital appreciation, well, you don't want to go in the big companies, large cap stocks. You don't want to go there. You want to find small businesses that become big businesses. Number 7, theoretically, the individual's edge has improved in the last 20, 30 years versus the professional. Problem is people have so many biases. They won't look at a railroad, an oil company, a steel company. They're only going to look at companies growing 40% a year. They won't look at turnarounds or companies with unions. You have to really be agnostic, 100%. You guys know on this channel, I love railroad. I love oil companies. I love coal companies. I mean, everyone hates coal. It's like the most evilest sector in the world right now, right? I've had so much success in the coal sector, steel, you name it. You really do have to be agnostic. I agree with Peter here. I buy biotech, I buy healthcare stocks, I do buy financials at different times, and as I said, I sell covered calls and generate even more income. So, yeah, 100%. Number 8. Long term, the stock market's a very good place to be, but more people have lost money waiting for corrections and anticipating corrections than in the actual corrections. Trying to predict market highs and lows is not productive. Once again, I think for 90%, 95% of people, this is absolutely true. People have, horrific, market timing, put it that way. And so, there's a few ways. If you think there's going to be a big market correction, then you can sell and move to the side, or you can keep your holdings, buy put options, buy index put options, buy put options on the actual stocks you own. There's ways that you can protect your portfolio without having to jump out of the market and then miss out on the upside. So that was a lesson that I actually learnt myself. And number 9, I think if you spent over 13 minutes a year on economics, you've wasted over 10 minutes. It's not helpful. Everybody wants to predict the future. I've tried to call the 1-800 psychic hotlines. It hasn't helped. The only thing I would look at is what's happening right now. And I agree with Peter Lynch. Modern day economics, Keynesian, is just rubbish. What I do push and what I do endorse is Austrian economics. And Per Byland is someone who is doing a fantastic job as an Austrian economist and using Austrian economics in the business sector for entrepreneurs, teaching entrepreneurs Austrian economics so that they can grow their business and be successful in the marketplace. And as an investor, I mean, that's what it's all about. And so that's why Austrian economics, in my opinion, makes so much sense and gives me an edge as an investor. Not sure if I've shared this book before or not. 100 Baggers by Christopher Mayer. Really good book that I recommend. It goes through and just shares a lot of stories, history in the stock market of different stocks that were 100 baggers. So, stocks that returned $100 for every dollar invested. So a $10,000 investment turning into $1 million. And, it gives some great points and lessons for investors that just invest in good quality companies and hold them over a long term. And, well, they grow into 100 baggers. So definitely recommend this book if I haven't already. Now, some of you may remember I did this video last month, Investing Lessons from Buffett, where I talked about my approach to investing and my portfolio structure. And in the video, I discussed how we use Austrian economics as our foundation, but then we break our portfolio into 4 parts: value stocks, growth stocks, option selling stocks, this is for income generator, and small cap stocks. And then we have our physical bullion, our options trading account. So this is where we buy and trade spreads. So we buy leaps and buy puts and bear call spreads, etc. Our real estate holdings, both residential, commercial, and our cash position. So what I want to do is basically in this video, this is when I first announced Finance Uncut Insiders, which is a weekly newsletter subscription where I share my investment approach, my investment portfolio, all the research and analysis that I do, and why we're in particular sectors. So you'll get all my trades, both the options trades, but also when we're buying a particular stock, why we're buying it, and also when we sell a particular stock. So what I want to do now is just give you guys a little glimpse or a sneak peek into what that newsletter will look like. All right, so here we go. Finance Uncut Insiders. Here's the report. This is what it's going to look like. We go through our Austrian economic approach and why it's so important and why we recommend you guys learn more about it. How we use a combination of Buffett and Greenblatt's fundamental value analysis and why it works and why it's so good, and how we learnt from these gentlemen how to apply options to our portfolio. Then, as I just mentioned, we break our investment portfolio into 4 parts. And then coming to that now, I'm actually going to share with you guys some stocks that we own. So I'm going to give you a couple of free stocks. So if you don't subscribe to this newsletter service, well, I'm going to give you 2 stocks that we own. So the first one is Stanmore. So Stanmore is a coal stock. It's hard to go past Stanmore, who are acquiring Mitsu's 20% of the South Walker Creek and Poitrel coking coal mine in the Bowen Basin in Queensland, as well as other potential development projects subject to FIRB approval. That's Foreign Investment Review Board. Settlement is $380 million US, subject to adjustments. Stanmore recently purchased 80% of BHP's Mutsi, so they're taking it completely over, and have gained a further 10.5 million tonnes of coal production per annum from existing projects. If we go down a little bit more, so their saleable coal production, 2.8 million tonnes in the first half of 2022. That's up from 1.26 million tonnes in the second half of last year. So they've already doubled that in under a year. Higher realised prices and significant uplift in volumes following the SMC acquisition during the first half of 2022. Seen a record revenue and underlying EBITDA delivered in just the first half 2022 of $726 million. Operational performance led to operating cash flow of $563 million for the first half of 2022. Cash flow significantly improved liquidity, $546 million of cash as at June 30, 2022. So that gives basic earnings per share of 32.37 cents per share. Our buy price was 49 cents in August 2020. That equates to 1.5 times earnings, and we're expecting some pretty big dividend payouts based on our buy price. Now, you can see currently when I added this chart to the newsletter, which was the other day, its shares were trading at $2.21. We currently have that as a hold. We aren't accumulating this stock. Now, we still think this stock has more upside based on a number of factors, based on their current earnings performance. So yeah, but we will, before we start trimming our position on this and taking profits, we want to enjoy some of the big dividends coming our way. So the next stock that I'm going to share with you guys is one that I have recently been talking about. It's a drilling company, DDH1. DDH is the ticker code. It announced an on-market share buyback program on the 1st of July. The proposed number of shares to be acquired over a 12-month period is just over 34 million shares, or 8% of its current capital. Added 15 quality rigs to end of the year with 183 rigs. A further 11 are on order or under build, making it a top 5 largest drill companies globally, or in terms of fleet, the number of rigs. Annualized revenue per rig of 2.9 million. That is up 6.9%, and their outlook is for increased margin per rig, which is fantastic in an inflationary environment. 14% increase in full year 2022 financial year pro forma revenue to 506 million compared to 444 million, above average industry return on invested capital of 27%. Now that is huge, guys. Our rule of thumb is anything above 10% is good, and that's on our radar to look at. So 27%, outstanding. 10% increase in underlying EBITDA. Let me just scroll up a little bit. Underlying, where are we? Underlying EBITDA, 113.6 million compared to 103 million, 22.4% margin. 17.7 million returned to shareholders in dividends, with a dividend policy moving forward of 30 to 50% of operating net profit after tax and amortization, which currently, based on the 17.7 million, is 5.37 cents per share. Basic earnings per share, which is based on EBITDA, is 34.47. Our buy price was just in the last several weeks, so we started buying in July and August, was 64 cents, which equates to 1.86 times EBITDA, with an 8.39% dividend yield and growing. Now, when they made that announcement, the share price, you can see, absolutely shot up. So from 64 cents to 85 cents, and we still have this as a buy. So we're still buying this company even at 85 cents. And yeah, I actually wouldn't mind a pullback because this company is dirt cheap, in my opinion. Once again, not financial advice. You guys, go, if you want, go do your own research, run it past your own financial planner, financial advisor, etc., etc. But there's a couple of stocks there. So this is the kind of thing that I'll have in this newsletter, is all of our stocks, all the reports, all the analysis, why we buy a stock, why we sell a stock, and when we're going to sell, as well as all of our options trades. So how we sell options for passive income, like Buffett and Greenblatt do, for compound. So we do own some big stocks, even though our focus is on small cap. We do own large stocks that we simply sell covered calls. We receive about 2% a month, so about 24% a year on average. And, they usually pay a 5-6% dividend yield as well. So we're getting about 30% a year just in income. And what do? We just reinvest it. We don't use that income to live off. We just reinvest it. So compounding it at such a high rate. So, they're boring, the big stocks, but that's why we use it, is simply for the options trade there. So as we continue going down, building an international portfolio. So we talk about the different markets and sectors that we're in and interested in. Outlook, some of our stocks that we've owned and why we've bought particular sectors, why we like small value and resource stocks over other sectors. You guys will love this one, why we buy junior explorers in two particular market cap quartiles, and that it really says it right there. And then the life cycle of a junior explorer, and why we invest in particular parts. There's times to invest and there's times not to be investing in this sector. And then once again, guys, important disclaimers, not financial advice. We do not accept any liability. This is not a recommendation to buy or to do anything. It's just for entertainment and education purposes only. So there you go. That's the newsletter. I still have to add the rest of our portfolio in there and all the analysis, but this gives you an example of what it is going to look like. So it's going to be a weekly newsletter. For those of you who are interested, now it's not free. It's not free. It is going to cost $1 a day. So if you can afford $1 a day, that's $365 US per annum. This gives you an annual subscription, a weekly newsletter for an annual subscription. But at the moment, we are going to give, as we launch it, we're going to give 30% off. So it's going to be $255.50 for those of you that do sign up now. If you are interested in it, send me an email. Here's the email address on the screen now. So send me an email. I'll put the email address also in the description of the video, not in the comments. If anyone tries to message you guys that's pretending to be me in the comments, ignore it. I will not tell you to go to some silly app, WhatsApp or whatever.
just check the description of the video. This email address will be down there, and it's the same one as on the screen. So if you're interested in getting this newsletter, send me an email. Let me know what country you're in, and I will give you some payment options, and we'll have this fully decked out with all of our portfolio by next week, and you guys will start to enjoy everything that we do. You'll see everything. So our wins, our losses, you'll see everything. So anyway, guys, if you like this video, please do us a favor and hit that like button. Really do appreciate it. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.
And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.